FTN Equity Capital Markets, and Lee Munson, Chief Investment Officer at Portfolio Asset Management. Thanks to both of you for joining us. Tony, let me start with you. A little bit of a decline here today. The Bears trying to take the market down, but not really able to.
Melissa, I really think what people need to focus on is what the next 1%, 2%, even 3% pullback could be, because it's likely. I mean, we're up pretty much in a straight line. I think what we need to focus on is where's the next 15 or 20%. And I think if you look at the credit markets, that would certainly argue for the upside, even if you wouldn't even come close to equaling the returns of the credit markets in equities if they bounced all the way up to 1250. Also, you would still be in a long-term downtrend if you bounced to 1250. That's how low we really got. And the credit, again, I'm the easiest strategist in the history of mankind to figure out. Watch corporate credit. When spreads narrow and go back below mean after they've been stressed, it's time to be bullish, and all the historical indicators agree with that.
Lee, what do you think about that strategy?
Well, you know, I think I like what Tony has to say, and I appreciate his comments on the credit markets. We've been picking up a lot of treasuries lately. We think that rates are going to go down and credit spreads are still going to narrow down to the lower end. But right now, what I'd be more focused on the equity side is really buying the quality names. I think that we're going to have a recovery that includes a personal savings rate, some type of positive personal savings rate. So instead of going after, say, a Coach or a Tiffany's as we get into a recovery, we're long things like an eBay or Amazon, especially eBay, where people are going to be buying and selling the products like Coach handbags or expensive items for Tiffany's.
But Lee, I think what Tony's saying is you're overthinking it.
Well, I might be overthinking it, but we have a rising market right now, so what I'm looking for is good setups in the charts. I'm looking for things that are going to be ready to make a 52-week high, and I think at the end of the day, you still have upside. Today, we were buying a tremendous amount, and if we have any more pullback, I'm going to be putting more capital and committing it to the market right now.
Yeah, Tony,
including commercial real estate.
Oh, well, let me get back to that in a second. But, Tony, it sounds like what Lee is saying makes a lot of sense. Is there any reason why you wouldn't buy credit markets like you're saying and pursue Lee's strategy in something like Amazon? I mean, the two things are not mutually exclusive.
No, you're still above normal for your credit spreads. The amount that they've come in, though, remember, high yield debt to treasury spreads were at 2,200 basis points. 2,200 basis points. They've come down now by more than they ever were wide before, and they're still attractive. So again, there's still opportunity in the corporate credit market, which again, that ultimately is a good thing for shareholder-friendly maneuvers by the company. So that ends up in the equity markets. So again, I think what we're focusing on is, where do you go first? Information technology, because you're not going to go out and just start hiring people again. You're going to try and innovate. You're going to try and get your productivity up, and you're going to do that through infotech. And again, healthcare is the one place where there certainly is a lot of spending. So those would be our two favorite areas, with industrials and financials, and consumer discretionary a little bit less so.
Lee, you lost me on commercial real estate, because, I mean, a lot of really smart people think that the shoe hasn't even begun to fall there, and it is without question going to. Where do you see the opportunities in commercial real estate?
Well, first I'd say a lot of those smart people are also talking about a bank failure back in March. You know, I think that the commercial real estate is not going to bring this market down. They're going to raise money the same way the banks did, by doing secondaries. And I think that the whole idea of why commercial real estate isn't supposed to work is that it's going to lag the recovery in the market. But I think that's priced already in. You know, if you look at some of the action over the last couple of weeks, we've seen REITs do nothing but go up. And I think that a lot of institutions like Goldman Sachs came out this weekend and say, buy puts, start shorting the real estate index funds. And I would say they're just grasping at straws, trying to find something to short in this rising market. But you get the rents. Literally, you get a higher income yield. And I think it's the same idea of what Tony's talking about, is look at some, you know, mediocre paper. It doesn't have to be junk. Look at some commercial real estate that's getting rents. I'm not convinced that this is going to take us down. They're well capitalized. A couple months ago, there was a rash of secondary offerings. Look at Boston Properties. They did a secondary a while back this summer. It's up $10 right now. And I'm sure Tony would agree. You look at some of the preferred stocks that are thinly traded in the REIT area, and it's just, I'm sure Tony and I are looking at those all the time.
We are. Melissa, let me put this in kind of a layman's terms. Everybody in the equity market or the financial markets argues that the government is manipulating it. They're involved. They're forcing lending. They're doing things to create liquidity, which is supportive to the market, but it's government intervention. The government's told you that they're going to intervene. So you can fight it, or you can do what's already taken place, which frankly I did for a little while, or you can know that the government said they're going to intervene in markets that are not functioning properly. They're going to add liquidity until they function properly, and that's what ends up happening.
Real estate, or you
Clearly,
think that's...
because it is a huge market, and again, if commercial real estate, if you combine commercial real estate, alt-A loans, subprime, prime loans, all adjustable rate mortgages, you would collapse the banking system today if all the default rates and everything with foreclosures was allowed to happen.
No.
The government's intervening in it, and they're telling you they're going to do it in commercial real estate as well.
I think we're making a different point, though, because I'm not saying it's going to take down the whole economy. I'm just saying that more stores that have leases on properties are going to go out of business, and commercial real estate, you know, has a lot of pain left in it still. I don't think it's going to take down the whole banking system and the economy.
It's sort of like if you look at the credit in Citigroup. I was just talking to our credit strategist here. If you look at the short maturity bonds, my buddy Brian Reynolds pointed out this morning. If you look at the short maturity bonds for Citigroup, they're trading above where they were pre-crisis levels in 07.
Okay.
So the stock's down from 50 to 4. It's in it.
Okay.
You know, that's part of the point, I think.
Guys, some good ideas. Thanks to both of you. Go ahead, Lee. Give us your last thought.
You know, I would just say that, you know, if people want to get involved in commercial real estate, I'd use something like VNQ or IYR. Use an index. There's some great names out there, but remember, outside of Simon and Vornado, these are small cap names. They're somewhat illiquid. You need to be careful out there.
Okay.
Thanks, Melissa.
Guys, thanks so much for joining us. We appreciate it.
Thank you, Melissa.
Here's some of the other stories we're following on the closing bell ticker right now. Best Buy downgraded to neutral from buy.